Raymond James Investment Management, to come in and speak to us. Good morning, Matt. Let's get a sense first off. How are you viewing some of what is happening, at least with regard to Japan? What are you sensing there, and what could the knock-on effect of that be, both on India as well as on the global marketplace?
Hi, good morning, Herb. It's always great to join. And I think what we're seeing in Japan is symptomatic of what we're seeing across a lot of the global markets, and in the US in particular, where there's a lot of risk-off sentiment. I think Japan suffers from uncertainty with respect to currency moves. I think you've seen investor hesitancy around a large fiscal package, concerns that the BOJ might be behind the curve with respect to addressing inflation in the country. And as a result, you're seeing a pushback from investors in investing in bonds, and you're also seeing extreme pressure being put on the yen. On the flip side, though, you're at least hearing the finance minister stepping in and saying that we're going to defend the currency. We've seen them do this before, especially on low liquidity days before holidays. So perhaps they'll step in to intervene. But similar to how I view the rest of the global markets, I think what we're seeing in Japan doesn't reflect the underlying fundamental strength of the overall market. So once we can hopefully start to see some stability, I think there'll be a lot of opportunities for investors. And in Japan, I think there'll be opportunities both across fixed income and in the equity markets, given the sell-off that we're seeing.
Right. Matt, hi, morning. So you're recommending a buy on dips, basically.
I'm buying on dips, but right now I'm being very, very selective about how I do it. You know, when you see markets that move the way that they did today, as frustrating as that can be as a manager of money, you just have to sit back, you have to respect the charts, and you have to be smart about when you start to put money to work. It's always important to remind our clients, you can start to dip your toes when you see big, big moves like today, but you don't want to put your full position in or your full addition to that position in until you really start to see fundamentals, until you see strength return to reflect where the fundamentals are. And again, I'll emphasize, particularly in the US, the underlying fundamentals are very, very strong. You know, we just came out of an incredibly strong earnings season. You saw Nvidia's earnings results last night. Very, very strong. It shows that we're not in an AI bubble, but I think there's just a lot of cross currents and noise moving through markets that are leading to this risk-off kind of self-fulfilling market narrative for right now.
Matt, you spoke about the Japan situation here. The government is going to announce a stimulus there. And with rising yields, especially for 10-year and 30-year there, do you expect a reversal of the yen carry trade coming into play?
It's left to be seen. I think you're seeing reluctance for investors, I think, to be putting more of those trades on right now. I think what's going to be critical in Japan is the size of the fiscal package we hear from Takaichi. I think seeing a package on the scale of what we got last year will calm a lot of investors' nerves. Anything meaningfully larger than that, I think, is going to lead to perhaps some more pressure on the yen and more pressure on fixed income markets. But when you look at Japan, I think the inflation narrative and the narrative that inflation is going to be out of control with spending more money is really, really misguided. There isn't wage inflation. And while inflation across the price of goods is certainly a real challenge for the BOJ, it's not unhinged. It's not out of control. There's nothing that I see in the market that says that the BOJ is facing a fundamental challenge with respect to getting inflation under control over the long term. Hence why I'm still optimistic on, I would say, Japanese fixed income and equity markets once we can get through this indigestion period.
And Matt, I'm curious to know, what about gold and Bitcoin? Because while right now you're seeing a risk-off play out there as well, but do you think they could fall harder than equities?
So gold, I don't think so. So you've seen some strength with respect to gold, or at least a hold up, given that it has also become more of a speculative asset. I'm quite optimistic on where gold goes. It's been a critical ballast to my portfolios really throughout this entire year, and have increased my exposure this year, as you've seen traditional correlation relations start to break down. So I think gold has fundamental drivers for why you're seeing strength, and a lot of that rests on emerging market central banks diversifying currency reserves, true store of value. Bitcoin, on the other hand, is much more of a true, I'd say, risk on, risk off play. It doesn't have that rooted fundamental reason for it to do well. Central banks aren't using it. And so when you see this weakness in Bitcoin, I think, Aisha, it's reflective of just weak risk sentiment. And I do think there could be scope for it to fall further. But I also think there's been a tremendous amount of selling pressure. And I do think we're getting near the point of capitulation.
Matt, what's the sense like with regard to AI, and what could the knock-on effect of that be, at least on the Indian marketplace? What's the sense there?
So I think India is in a good place. I mean, you've seen India hold up well. It's why I like India as a portfolio diversifier, also because earnings have been quite strong this season from India. So I don't think India is caught up in the same concerns around AI and valuations that a lot of other markets are, especially the US. So I think you can look at India as the emerging market that has stability. You can look at it as being more consumer driven, more rooted in cyclicality, which I think is healthy, given how you've seen markets like South Korea and Taiwan and the Chinese internet market move so far this year. But at the end of the day, the high quality AI names, particularly those in the US and some of the semi and semi-fab names in emerging markets, again, we've seen really, really strong earnings resiliency from these companies. And what you've heard over the course of the past 2 months is that you're seeing continued capital expenditure on the part of the hyperscalers. Most of them can fund this from free cash flow. And even after these large CapEx numbers, you're still seeing the likes of each individual company printing $50 to $70 billion of free cash flow per year. So I don't have an issue with where the AI trade goes in the near to medium term, which is why I think the sell-off we're seeing is leading to a lot of opportunities. And I'm actively looking for places to buy the dip in the data center trade, the electronic equipment trade, more on the industrial side, as well as the highest quality hyperscalers that are now trading, anywhere from 18 to 22 times forward multiples, which is really, really low. After today's sell-off, Hirsch, Nvidia is trading at 26 times forward earnings. It's hard to argue that's expensive for a company that's growing year over year at 55%.
Matt, what's your position on the December rate cut after the September numbers which have come in, especially on employment numbers and the unemployment rate? Where do you think you are putting your bets? Is it going to be a 25 bips rate cut or a pause?
So I think we're more likely to get a pause at this point. I was a little bit surprised by how hawkish the turn was when we got the October meeting notes. And so it seems like there's a majority of FOMC board members that are hesitant to cut rates in December. And we're not going to get any useful economic data in the US that's timely before the FOMC meeting. So I do think it's probably going to be a pause. But what's going to be really important is following the summary of economic projections and what the Fed's likely to do next year. I do still think if we skip December, you get a cut in January. And so that rate cutting cycle still remains in place.
Okay, Matt, we'll leave it at that. Thank you so much for coming in and speaking with us. And of course, that's the global perspective. But let's round it up. Snehi here from